Welcome, I'm Jay Levitt. Thank you for watching this video. Primata's Gemini family is based on a unique, extremely safe arbitrage investing concept. You will see two strategies, one for accredited investors and the other for IRAs and other investors. Both exhibit excellent rates of return. More importantly, their fluctuations or drawdowns are phenomenally small. Volatility is minimal. Managing risk is at the heart of my strategies. It is more important than generating profits. I focus on two forms of risk: market risk and corporate risk. Most experienced investors understand corporate risk. Diversification is the primary defense against it. Market risk is real, as many people sadly learned in 2008. This chart is a display of the major country ETFs from 2007 to 2012. As you can see in the rectangular region, country diversification did not protect anyone's capital. Not one of the ETFs escaped the market collapse in 2008. Charts of other types of sectors behave the same way. Most passive investors lost 50% of their savings during this period. How well did your investments do? Gemini's arbitrage strategy was designed to protect against this form of risk. Managing risk is central to the Gemini funds. Its strategies are based on arbitrage and market timing. In arbitrage, there are two sets of investments, one long and the other short. The purpose of these offsetting positions is to minimize risk. The market timer allows for different strategies, one when the market is bullish and another when it is bearish. As a result, you will find these funds generate strong, consistent profits while preserving capital and managing risk. William Sharpe, who won a Nobel Prize in economics, created a tool that helps us evaluate investment alternatives by factoring in risk. A negative evaluation tells us it would have been better to put our money in T-bills rather than in some funds. The higher the evaluation, the better the investment. Unfortunately, few funds publish their Sharpe ratios. You will see why in the next slide. Primata, in contrast, proudly reports the Sharpe ratio of each of its funds. This chart starts in 2007 and runs through mid-2012. The Sharpe ratio shows us it would have been better to invest in T-bills rather than the S&P 500, the red curve. That also applies to these well-known mutual funds. This is why mutual funds do not display their Sharpe ratios. Primata's bond fund, Secura, drawn in blue, shows the type of curve we'd prefer to see. Its profits are consistent and the drawdowns are small. Secura clearly departs from these mutual funds with a Sharpe ratio of almost 8. In arbitrage, two positions are held, one long and the other short. Presumably, losses in one position are offset by gains in the other. The central question remains, how can you make any money with arbitrage? Here's how I solved the problem. First, I decided to use different strategies in bull and bear markets. Next, I short the market with the S&P 500 in bull markets. In addition, I'd represent the S&P short position with options acting as insurance. Any stock position has an equivalent option position. In addition, options provide more flexibility in designing protection against risk. During bear markets, I only buy bonds instead of having two opposing positions. I'm only showing you the charts for the Titanium Fund. It's reserved for accredited investors. The other fund, Platinum, is for IRAs and other investors. While the data is a little different, its charts are indistinguishable from Titanium's. The red portion of Titanium's top graph shows the behavior of the S&P 500 index, while the blue shows the amazing growth of the Gemini funds from 2003 through the end of 2012. Quarterly returns, shown on the second graph, were obtained by interpolating between the trades. The few losing quarters for Titanium were all small, as opposed to the S&P. For 30% of the quarters, Titanium gained over 10%. Titanium technically is not a form of arbitrage. However, the charts show it has not suffered from market risks like the crash of 2008. Its large drawdowns were not during that big fall. That was a profitable year. The Sharpe Ratio and Kalmar both indicate that the drawdown is quite reasonable with these exceptional compound rates of return. Options were only introduced as insurance against potential market losses. Diversification was provided by the momentum basket. In both bull and bear markets, all trades were simply buy and hold. Stops were not required. The bond funds kept equity at work during bear markets. Few funds, if any, can match this level of performance over this period that includes the market crash. The Sharpe Ratios are proof of this statement. You have already seen the outstanding results produced by the Gemini funds. The Gemini fund's directional investing strategy is based on arbitrage and market timing. Titan is another Primata family of funds. Their tactical asset allocation strategy has comparable concern for risk and similar results. It also has a video. Secura's bond fund is available if you are only interested in a fixed income fund. I hope you enjoyed this video. For more information about Gemini funds or any other investments of Primata Funds, LLC, email me at drj@primatafunds.com or visit my website at www.primatafunds.com. If you would like to learn more about Primata's services, either send me an email or visit my website.